The latest core PC update and Fed Chair Jerome Powell's speech on Friday went pretty well faced with an empty audience. The second quarter now kicks off with a 10% rise in the S&P 500, encouraging data from China over the weekend and quite a positive setup for further gains in oil prices. So welcome to a slow Easter episode. You are watching Swissquote's Daily Market Talk. So hi guys, from a slow Easter morning. This week starts very slowly as most Western markets are closed for Easter holiday since Friday. But it didn't prevent Friday from being quite an interesting session in terms of economic data release as the US revealed the latest core PCE print on a Good Friday, and that's obviously the Fed's favorite gauge of inflation that attracted some people's attention still. Plus, the Fed Chair Jerome Powell talked right after the release of that data. So in terms of data, well, Friday's set of inflation numbers, income and spending figures were not so bad to say the least. The headline figure came in aligned with expectations at 2.8% level. That's down from 2.9% printed a month earlier. The monthly inflation figure, so the monthly core PCE came in just at 0.3% as expected, but the prior month read was revised up to 0.5%. Now, the bad news for inflation and for the Fed is that personal spending jumped more than expected in February. But the good news is, again, for inflation and for the Fed, is that personal income fell more rapidly than the market expectations. Now, I emphasize the good and the bad news for inflation and for the Federal Reserve because good news for people in the street are not necessarily good news for the Fed and for inflation and vice versa, because the Fed cares about its inflation goal. And even though I'm sure that the Fed President Jerome Powell and other Fed members are more than happy to see people earn and spend the roughly, too much gains and too much spending from people are obviously not good for fighting inflation. So please do not get me wrong when I say that it's good news to see people earn less. It is good news for the Fed. It is good news for inflation. And you should really keep it that way. And indeed, the Fed President Jerome Powell talked a little bit later than the data release on Friday. And he said that, the fact that the US economy is growing at such a solid pace, the fact that the labor market in the US is still very strong, it gives them the chance to just be a little more confident about their inflation fight and that the fact that the inflation is coming down before they take important steps. Now, you could interpret it as you want, but it wasn't very clear to me. Now, of course, as the markets were mostly closed on Friday at the time the data came out and Jerome Powell spoke, we didn't see much reaction on Friday to, these news. We see slight moves this Monday morning in the markets, but I won't spend too much time commenting on the price levels as the real direction from investors will be clearer tomorrow when most major markets will reopen after an Easter holiday that has happened to be quite expensive in terms of chocolate prices this year. But very shortly, the US 2-year yield is down to 4.60% at the time I'm talking here this morning. The 10-year yield hovers around 4.20%, and the US dollar index is steady-ish near a 1.5-month high level. Attention will be shifting to the US jobs data this week. We will talk a lot about that throughout the week. Hopefully for the Fed again, the data won't be too strong to spoil the rate cut expectations. Now, the euro dollar kicks off the week under pressure. The Japanese yen bulls are still nowhere to be found despite the Bank of Japan's Tankan index falling in the first quarter for the very first time in a year due to shutdowns in car plants in the past few weeks. Now, the large Japanese manufacturers also see their business conditions deteriorate moving forward in the second quarter, while there has been quite notable improvement when it comes to the Japanese manufacturers of petroleum and coal, and it looks like they will actually continue to do just fine as we enter the second quarter of this year with oil prices on a relatively solid positive footage, because the US crude is up by nearly 20% since the beginning of this year, and that's on the back of, well, tense geopolitical environment in the Middle East due to the Israeli war, a restrictive stance from OPEC when it comes to the supply cuts, and also this robust demand predictions, and that's also due to the expectation of lower interest rates from the major central banks around the world for the rest of this year. And for now, the Chinese stimulus measures and an eventual Chinese economic recovery were not significantly priced in the oil prices, but the latter is still an important upside risk that could actually be brought back on the table if, of course, we see some encouraging economic data coming from the struggling EM giant. And indeed, the latest PMI numbers released during the weekend from China were quite encouraging, because both the manufacturing and the non-manufacturing PMI data showed a faster than expected expansion in March in China. Especially the non-manufacturing PMI jumped to 53 level, so that was the highest level since last summer. But note that input prices fell for the very first time since last summer as well, on lower material prices to stimulate demand in China. And the Chinese property crisis gave no signs of abating in the first quarter of this year, meaning that the enthusiasm regarding the Chinese economic data should still be taken with a pinch of salt by investors. But anyway, I think that the weekend data from China has still a positive impact on oil prices on the slow Monday morning, which actually sees the barrel of American crude trade at the highest level since this year started. Now, OPEC will be meeting this week and is not expected to make any changes to its supply cut strategy at this week's meeting. The cartel is set to extend its supply cuts until the end of this new quarter, remember. And also remember that the IEA now expects supply deficit in 2024, while they were actually looking for a supply surplus in their prediction just earlier than the last prediction. So as a result, the upside risks in oil prices prevail, and these positive underlying factors should actually encourage a further rise of the US crude prices to $85 per barrel level. This is the prediction in the short run. In the equity space, the first quarter ended last week with S&P 500 recording its best performance since 2019. The index gained more than 10% in the first 3 months of this year, even though the Federal Reserve rate cut expectations went down from 6 rate cuts for this year, with the first rate cut that was supposed to happen in March, remember, to only 3 rate cuts this year, with the first rate cuts supposed to come on June with a bit less than 70% probability attached to it, according to the activity on Fed Funds futures as of today. Obviously, the AI really certainly keep things on a higher note for the US stocks, but the European STOXX 600 index and the Japanese Nikkei also ended the first quarter of this year with a very, very strong performance, even though not that Nikkei is having a hard time this Monday morning, due to a less than ideal Tankan index. Elsewhere, Turkey held municipal elections on Sunday, and they ended in tears for Erdogan-backed AKP leaders in major cities in Turkey, including Istanbul. Now, even though the news could actually hint at a potential change for a more rational policy package in the future, so for better, we won't necessarily see a meaningful change in the close future for the Turkish markets and the lira. The monetary policy in Turkey will likely remain unchanged, and the dollar TRY, which is trading just higher in the wake of the latest municipal elections in Turkey, should unfortunately continue to trend higher, potentially at a higher speed post the elections, as the Central Bank of Turkey might put just less weight to counter a further depreciation in the Turkish lira now that the elections are behind us. So this is all for this slow Easter Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, well, good day trading and have a nice Easter Monday.